You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way. This week on The Investor Way, it's myself, Jon McEwen, and I've got Gavin Gordon, who is a good friend of the podcast. He's a junior doctor working in the northeast of England, and he has got into investing relatively recently, and he takes a slightly different view to Sam Ball of the podcast and follows a passive approach. Gavin, do you want to introduce yourself and talk a little bit about your investing style?
Yeah, no problem. So firstly, thanks very much for having me on, Jon. Big fan of the podcast. I'm glad to see it's going strongly. You're coming up to a fair few episodes now, so well done on all your success with the podcast. So I suppose we should just start by saying, like, myself, Sam and Jon, we know each other very well. Probably it's coming on to 10 years now, kind of like first all met each other at university. And we've got obviously lots of insights from Sam's early days, of course, but the main one from way back when, Sam was always big on stock picking, always had something to say about the next big thing or the company that he was most excited for. I won't go into details with that, but that was the kind of thing. And, you know, his enthusiasm was infectious to a degree. I was always a bit more skeptical, and I just kind of was doing what most people do at university. Didn't really think about it that much at the time, just focusing on getting that degree, basically. But that's always been in the back of my mind, and I was kind of always vaguely aware of it. But it always seemed like too high risk for me, and I was like, well, there's probably something else on the cards. But it all came about, really, when I first started working, and I'd been working at this point for about a year.
And Gavin, what do you do? Tell us about your job.
Oh yeah, so I'm a junior doctor in the northeast, and I'm basically in my second year of surgical training at the moment. Still kind of like choosing specialties, but so I'm basically an early surgical trainee, and very much really enjoying my job at the moment. So pretty good.
Okay. So you're pretty busy. You're on a hefty rota there.
Yeah, so my rota changes quite frequently just as part of the training program, but I've been, since graduating, on a full-time on-call rota in line with the junior doctor contract. But you're looking at many on-calls, so it's very difficult to say, but currently I am on-call every other week, and I'm typically on nights every third or fourth week, and a night shift set would be 12 hours from 8 p.m. to 8 a.m. And that's just what I'm on at the moment, but that's fairly standard for the last three and a bit years now.
And you mentioned with Sam, obviously he enjoys being an active investor, and he does a lot of the fundamental research himself. He's got that background at university. He was doing accounting and finance, and he understands, and now is practicing as a chartered accountant. He's got that understanding of reading accounts, reading reports, and that's able to influence him in terms of doing the research, that fundamental research himself. You don't have that background,
no. And
you've got what sounds like a very busy rota.
Yeah, exactly.
Has that influenced, first of all, not having the accounting background, and then having the job that you have, how you invest in your investing style?
So yes, I would say, though, there's both push and pull factors as to why I've ultimately become like a diehard passive investor.
Okay.
And definitely part of the push factors away from the active investing is definitely the time and opportunity cost. As you mentioned, you guys go into great detail, really do your reading on lots of different things. I would say I'm sure I could, but I don't have the time. And so that's kind of like the push factor away from it. You know, I could be spending my time doing other things. So kind of like doing it on active investing is not currently what I'm interested in doing. But then you've got kind of like the pull factor saying that ultimately passive investing in the long term is a better strategy anyway, whether or not you know everything there is to know about the stock market. A lot of the data and a lot of the advice people give, including people like Warren Buffett, is invest it in passive index funds. So you've got two sides of a coin there, basically. So yes, definitely the time commitment, and the energy commitment and the expertise, but also strong argument to be made. Hopefully it's not too controversial on the Investor Way podcast that actually passive investment is a better strategy overall.
So you're saying both, even if you had all the time in the world to consider different stocks, you don't think even with the time you would necessarily be able to pick those stocks that would outperform the market in the long term?
It's difficult to say, but ultimately that's my current position. Whether that changes in, over the course of my lifetime, who's to say? And I would add, it's not just my position either. There's lots.
Oh no, but we're talking about you today, Gavin. So and quite everything else aside, you don't have the time anyway. So it's sort of you could say it's irrelevant. And you mentioned Warren Buffett. I mean, Warren Buffett is probably the most famous active investor. He forms his own portfolio, has done for decades now, not quite a century, but decades. And he's successfully outperformed the market. Do you think that there is something there? Do you think certain individuals do have the ability and the talent to do that?
No, absolutely. And obviously there's a huge financial market, and people do make huge gains on individual stocks and actively managed funds. There's absolutely no denying that. But all things being equal, for the average person, what is the most effective and safest way of investing your money? That's kind of like the question for me.
Okay.
So my personal great ambitions is not to become the next Warren Buffett.
Okay.
As nice as it would be, I'm very happy in my career and pursuing my career, and I'm very happy to see my investments grow over the long term in a very passive manner.
Okay. And you weren't sort of tempted by having some sort of wealth manager managing the money, putting it in different funds for you? That wasn't something that appealed, because I know certainly at a lot of the events at university, there were lots of people advertising those sorts of services. That never tempted you?
No, because ultimately I read the material that was out there, and in my view, it's very accessible these days. It's very transparent what you're getting involved in. You can get all the information you want from all the different thousands of different funds, so you can make informed decisions by yourself. And of course, there's always a cost to all these things, and these financial managers will be eating into your returns. And at the end of the day, are they actually themselves going to do any better than you were just by picking generic passive index funds? I'm skeptical. It's something you can go into at a later date, but the most important thing, in my view, is starting and just getting that regular investment kind of like flow going, so that you yourself are becoming more comfortable with what you're doing.
And you talk about index investing. Is there any, or are there any particular indexes that you invest in?
Yeah, so when I was doing my reading, it was basically what's low cost and what's broad and ultimate, and what do other people use. I think the fact that if lots of people are using it, not only does it have a degree of trust to it, but also any kind of like troubleshooting questions, you'll quickly be able to find any answers. So based on that, the standard platform a lot of people use is Vanguard, which I'm sure your listeners are well aware of. And through Vanguard, they've got, I think in the UK, they've got, I think just short of 100 funds. Don't quote me exactly, but they've got, just short of 100 funds. And then of those funds, once you do the narrowing down of what you personally want from a fund, you're left with a handful of options. And then I've kind of like picked, currently the bulk of my portfolio is two of those options, which I'm happy to talk about today.
Okay. So how do you separate it then? For you, is it sort of geographical? Is it sort of whether it's small caps, the size of the companies, large caps, or how do you go about it?
So firstly, I wanted 100% equity. I'm still relatively young in the investing game. I'm happy to ride through any losses and actually increase investments in losses. So as ultimately to reap the benefits from that. And also location was the other main factor to consider. And for me, when I'm looking at it, I think the important thing for me was having world exposure. So I wanted a world index fund. And I thought the growth potential of the American market through some kind of American index fund was also really important to me. The other factor, which I thought was quite important, was the use of accumulation as well. So I didn't want dividends just being given to me for then me to reinvest. I knew accumulation was an entity, so I just wanted all my funds to be accumulation, so that I didn't even have to think about it.
So largely speaking then, dominated by the US, but it does have exposure to the rest of the world. And then those dividends that are paid out from all of the companies that contained within the fund are then automatically reinvested. So you're not having to go back manually and doing that. Is that's sort of more or less? Yeah.
Yeah. And that kind of like fits with my kind of mental attitude when coming to it, is that I want all my dividends reinvested anyway. So it kind of like removes that option that I can take the dividends away, which I quite like.
And what's your feeling towards being allocating more to certain geographies rather than, say, purely by the market cap of the companies within those countries?
Ultimately, it's just, in my view, it's how much faith you have in that country to grow. What do you think the general direction of that country will be? And if you look at the world stage, what you think of the general state of the world economy will be? And I think over the long term, the world economy will improve. And I also think that the States, well, historically has grown massively. And I still think it's got a lot of potential for growth as well.
And that's interesting, because I think in the UK, we are naturally biased towards the home market. So people, even if they take an indexing approach, may just buy, say, the FTSE 100 rather than, say, the World Index or the S&P 500. And again, historically, it's not as though the FTSE 100 has done badly, but you see perhaps more dynamic companies coming out of the States. Certainly those big tech names, which have dominated for the last 10, 15 years, have virtually all been US based.
Yeah, I'd say that's fair enough. I think it's you're right, the tech companies in the last 20 years or so. I've read a fantastic book called The Power Law that goes through how these tech companies came about, their kind of like financing models, and just the potential for growth and the low debt with lots of them as well. Just makes them almost uniquely attractive in how good they are as an investment.
Yeah. And then I suppose something else that comes into it, or has done, particularly if you're stock picking, is the valuation of these companies. And they certainly haven't been cheap for a very long time. No. And there's been that, well, recently we've seen it particularly, but that real volatility there. Yeah. Do you think indexing or index investing?
Yeah. So it's kind of self-selecting indexing in a way, in that, let's take the S&P 500. If a company just collapses completely, or is, basically just collapses, it will be removed from the S&P 500. And also, you're not just dealing with tech stocks as well, you're dealing with the entire market. So in terms of equity, it is probably the safest way of approaching stock market investing.
And I think that's something else as well, the psychology that you'd mentioned before. That's, it's not completely taken out, and I appreciate you can trade index funds, but there's much less of that compared with individual stocks, and then the rise of free trading platforms, which they almost gamify the process rather than it being that long-term strategy that you're committed to and that you, I suppose, eventually reap the rewards of.
Yeah, so I'm almost so convinced by the more passive way of approaching things, in that I'll just give you two examples. But some people criticize Vanguard for not having a mobile app. Now, I actually think that's a massive advantage, because you shouldn't really be doing Vanguard apps on the go. You shouldn't be showing it to your friends. You shouldn't be making these quick judgment decisions on your investments. You should be taking the time to sit down at your desk and kind of like going through your options and then adjusting things. So that's like the first example. I was actually drawn to Vanguard because it lacks an app, which sounds a bit funny. but it removes that temptation. And on that thread as well, obviously you have two different options with passive investing, broadly speaking. You've got the classic index fund, but you also have ETFs. And to be honest, they are very, very similar, and you could pick either one, and I'm sure people do. But the reason that put me off about the ETF is that, again, it almost encourages that stock monitoring, stock watching attitude of, I need to know what this stock is doing throughout the day. Whereas I genuinely didn't need that. I was quite happy with my investments, and I was quite happy just to let it ride over the long term. What a stock's doing on any given day makes almost no difference to me whatsoever. So I actually avoid ETFs for that reason. So my strategy is both kind of like, I'm positive, but I'm also trying to avoid temptation as much as possible.
And am I right in thinking that you've sort of automated that process as well? So a part of your paycheck would go into this every month, regardless of what the market's doing, and anything else that might be going on in the world?
So yeah, primarily it's the dollar cost averaging approach. So it's regardless, you're exactly right. Regardless of what's happening, just the same amount goes in every month. I kind of like make that judgment on how much I'm going in, depending on personal expenses,
Sure.
what my salary is and where I am with my 20k tax allowance ISA. But yeah, so exactly. So I automate the process, take the feeling out, and then just dollar cost average through things. Even I can get tempted sometimes if I see a dip in one of my index funds, and then I think to myself, buy low, sell high kind of thing. I need to bolus. I need to put in loads of money right now kind of thing. Even I can get tempted by that, and I've done it occasionally on very very low levels. But of course, if something goes down from 10,000 to 9,000, doesn't mean it's a bargain. And if it goes down another 4,000, but
it is very difficult, and that's something else with the psychology. It's getting anchored to the prices that and then attributing greater weight to that. But it's even with indexing, you still get it, but to a lesser degree, or you would hope to a lesser degree. And I think it's important to have the insight into it. And I suppose as well, the more you automate it, hopefully the less the bad psychology creeps into that. But it is very difficult when you see the green and the red and the endorphins are going.
Yeah, well, exactly. Yeah. And also, it's interesting, but by its nature, it's interesting. So I probably, maybe a bit of self-criticism, I probably look at my account more than I should.
Yes.
And that's not because, that's not because I'm doing these high stakes deals or anything like that. It's literally because I'm just interested to see what's happened. How has that piece of news affected it? Why it's gone down a little bit? I'm not going to action any of these information, but I just like it. So I suppose from a hobby kind of point of view, it's good. But you're right. It's very easy to sit here in a podcast and say, automate and take your emotions out and things like that. But when everyone's aware when you're sat there looking at it, it's not that easy.
I mean, I find reading different, I suppose, veteran investors, their writings. Well, I like to read them fairly regularly. They probably are biased, the ones that I attribute more value to. But I think what I do get from reading from the sort of the veteran investors is in times of the market uncertainty, you get, I suppose, that support, the strategy that you're following is the right one. And they've been through not the same, but similar events. And stick with it. Stick with your guns. Stick with those your fundamentals of investing, which I do lean towards you to you, Gavin, in terms of a general dollar cost averaging in some broader world index funds.
Yeah.
But stick to the strategy, because the psychology, again, it can be very negative, because it's nice when you see it's all green and you've been in a big bull market, as we have been for some time. But then when you're hit by something, and I don't know, COVID probably wasn't the best example, but in those initial weeks, goodness, things fell quickly. And I was seeing the red, I was checking. I didn't actually, I wasn't having a pleasant time. I was having a very unpleasant time, quite apart from everything that was going on with COVID itself, just from the portfolio point of view. And stocks, they were in free fall. I'd be waking up, stocks that would move, 1%, 2% every day. They were going down 10, 15% a day. You would think thousands of pounds just wiped off. And it was very difficult to detach yourself and remove yourself from that. And it's difficult because I suppose we had all of that money from furlough, and you saw that in the US, in the UK, and around the world. Money being printed, money being pumped, and then you had this very rapid recovery. But you didn't know that was going to happen at the time. And now I suppose we're seeing inflation being certainly more problematic, something that hasn't been an issue for decades. Coming back again, it is difficult to remove yourself, even with indexing, I think, and just staying put, and also keeping, staying positive about things, because you can get pretty down about these things when you see those paper losses. And I appreciate you're not actually crystallizing them unless you sell, but it's seeing the red and seeing in the minus double digits is.
And I still have memories of just talking about it at work and things, not in, just a general interest kind of thing. And then you talk about my passive investing strategy and what platforms I use and everything. And the person's like, oh, well, how much have you made? And I'm like, well, I'm down 10%. and then the other guy is like, well, your strategy's rubbish, mate, kind of thing. But then what your kind of like view is, well, what you've got to believe deep down is, you are in it for the long term. And such things are relatively minor. And I suppose I don't see this as, a path to great riches early. I see this as a way to kind of like financially secure myself, and also for interest as well. So I really enjoy my job, and I get a lot of skills, a lot of joy from it. So I obviously budget things carefully, so I'm not dependent on my index fund investing for my day-to-day living. Now, lots of things can happen in the future, but that's currently where I am, and I think I'm sitting fairly happy with my balance. But but that's part of the process. Like part of the process is that personal reflection. How much are you comfortable with? How much do you think you might need in the future? How big's your emergency fund for you to live comfortably? What other things are going on in your life?
Yeah.
And so I think investing can be incredibly self-reflective as well. You've really got to think about yourself and what you want and what your position is, and then take it from there, really.
And I think those people that you mentioned at work, it's quite clear from anybody who has invested that it's never plain sailing, and things don't just go up. I mean, the market fluctuates all the time, and then there are bigger movements caused by world events that happen at others. And it's just ridiculous to suggest that the strategy isn't working after a short period of time. Like, did you say November 2020 was when you really started?
I think so, yeah.
Over a couple of years. I mean, and you're owning over that period of time, whether it's whatever the sort of the value on that day is, you own more stock, and you're continuously adding to that over the long term. Yes. And I think those people, I don't know whether they'd invested or had any investments themselves, but it's certainly not, I don't think, in any serious investor's mind that the strategy is not working, because over 2 years you may be down a bit at the moment, and there has been a big pullback recently too.
No. And ultimately, you can only focus on yourself, can't you? And certainly, as a private passive investor, I'm quite happy with my strategy, and then I'm happy to talk about it. But if someone's not convinced them, that's fine as well.
And you mentioned as well the sort of the security that you had in the future. And I suppose, I know that we've talked off air, but you've got a defined benefit pension. So that, I guess that allows you a little bit more flexibility, because you've got a greater degree, or you've got a very generous pension, and that would allow you to make, be a little bit more adventurous and go 100% equity with your investing.
Yeah, I think I would anyway, regardless of my job, just due to my age. But what I can see myself doing, particularly as I kind of like, I start using my ISA more and more, and it grows just from an index point of view. Once I'm happy at the size of it, that compound interest is really starting to take over, then I think you're right. Just due to the nature of my pension, I'd be able to kind of look at the riskier stocks, maybe start listening to the Investor Way fantasy portfolio of 2045 or something, and start picking things of that nature as well. But it's very much that's very much for the future. I'm open-minded, but at the same time, I'm very happy with what I'm doing at the moment.
And we'll check in. It might be the next episode actually, and see how the portfolio or the Investor Way fantasy portfolio is performing. I know that this year 40% of managers have underperformed the FTSE 100. We're going for FTSE All Share, which might...
Okay. Yeah.
I'm not sure. We could well be part of that 40% or so that have underperformed. But interestingly, with the FTSE 100, I did hear this or read this earlier in the week, that 60% of active managers over the last 10 years have actually beaten the FTSE 100. I appreciate that's not the strongest performing index. And if you were to ask the same question with the S&P 500 over the last decade, I'm sure you'd be talking about far fewer numbers there.
Yeah. It's definitely possible. Yeah, but moving on, John.
Moving on. I was going to ask you, what's your take on other asset classes, whether it's commodities, property, Bitcoin even?
Oh dear. Okay, where to start? So I think it all goes back to almost like value investing standards. Does something have intrinsic value or not? I.e., is it producing cash in some form or another, or isn't it? And I would personally take the Warren Buffett / value investing mindset that if it's not producing intrinsic value of some description, then what is the value based on? And if it's not based on anything, then how much are you personally willing to invest in it? And I see it as maybe something you could do for a bit of fun and a bit of interest, but I would never keep it as a serious part of my portfolio. And that is commodities and anything like crypto, NFTs, anything like that. I've never really been tempted by any of them.
But even those commodities, more of your gold, your oil, your copper, that they don't appeal either.
I think it's well outside my circle of competency, I think. And ultimately, the oil by itself is not producing any dividends. It's not producing any rent money. It's not, I don't know the first thing about oil trading, but a company will produce revenue and profits and will redistribute it to investors, kind of thing. So that's basically the reason. It's outside my circle of competencies. That's
fine. Because I would say that I'd largely agree with what you've said and have a similar strategy. The only thing that one of the things I do differently, there aren't that many, is that I do have an allocation to commodities. And funnily enough, I follow an index approach with that too. I've got the Bloomberg Commodities Index as part of my portfolio. And again, just add a little bit to that. But that's an index of...
So just out of interest, what's your rationale with that?
So we can come on to influences in some books that we've read, but I did read a very good book on by Andrew Craig, How to Own the World, and it largely followed a similar format to what we've talked about with that, owning the world, and you can do so very cheaply through either ETFs or more traditional mutual funds. But you can also have a similar thing with commodities. And the rationale behind the commodities is that they are a hedge against your inflation, because they are, I know with some exceptions, or big exceptions like gold and silver, but essentials of life. So if you buy into those and you have a percentage allocated to commodities, it's a hedge against inflation. It's not going to be delivering growth, but it's more that hedge against inflation argument of, I suppose, physical things that are intrinsic to our everyday lives. And that's that reason being, the holiday running out of time.
Oh no.
Free. I can upgrade for free for the Christmas. Sorry, Gav.
No, you're right.
Shall I just upgrade?
That's nice,
119 annually. Bloody hell. See, Sam has his boss's account, so he's able to just use the work one. NHS don't offer us that, unfortunately.
No, they don't.
I think we've largely wrapped up commodities. Property, Gavin, is that something you're interested in now in the long term? Do you see it as a home, or do you see it more, there being more to it, and potentially sort of property as an investment in itself and I guess a property portfolio ultimately?
Yeah, so I think, in the first instance, so I'm not a homeowner at the moment, just due to the nature of our training, we're constantly moving. I'll probably have to move region again in the next year. But I do have a lifetime ISA. I'm very keen to buy a property at some point in the near future. We'll swerve the discussion on the housing market and interest rates just for the time being. So that's something from a personal view as a home is very important to me to get. Now, my view is until I've got that in place, I wouldn't consider exploring that further. So I need to get comfortable with the process of mortgages, of home ownership, and of the legislation and the details around renting as well, before I consider that as an avenue to go down, basically. Of course, the house itself will accrue capital value, so that is something to consider, but obviously it's not liquid. So I think overall, I'm very keen to own a house. It's not something I'm going to pursue in terms of passive income streams right at this moment in time. I think we're looking at a fair few years down the line before I kind of have a look at that.
Yeah. No,
What do you think? What do you think, John? What about yourself?
I tend to agree with you. I'm not 100% on where I would be for the next 5 years. And I think until in my mind, until I know that, I wouldn't want to buy a house. And, there are a lot of people now with interest rates going up, house prices coming down, who are in negative equity. And that's not a fun place to be, particularly if you're someone who's younger and then you do need to move. You're in a very tricky position then. So I think in the near term, or in the near future, yes, I would like to become a property owner, but it's not the priority at the moment. And when it comes to a property portfolio, again, that would be further down the road. Also, you mentioned the ISA, which I'm sure a lot of our UK listeners will have come across, perhaps not some of our US listeners, but it's essentially a tax wrapper that all UK taxpayers can make use of. You're allowed to put £20,000 a year into it, and you can have that as cash on sort of short-term bonds. Don't have to pay any tax on the money, but you can also invest it. So you could have a stocks and shares ISA, and that money, the dividends aren't, you don't have to pay any tax on those. And also the eventual capital gains, assuming there are some, you won't have to pay any tax on either. So it is a very generous tax break that we have in the UK, and it's one that you and I are making the most of.
Yeah, and absolutely. And it's kind of like a good personal target to try and max out that £20,000 per year. But it's actually quite a sizable sum of money if you compare it internationally to what other countries offer in terms of tax wrapped, protected, like investment offerings. It's actually quite good. Up until I think it was 2017, I think it did actually increase year on year. I'm sure listeners can correct me on it, but they've basically frozen the upper limit for the last like 5 or 6 years. Stayed at 20,000.
You are right. And it's one of those big tax breaks that Sam will tell you in his capacity as an accountant is very underused by the public, despite having such a generous tax break.
Yeah, it'd be very interesting to look at the percentage of people that max out the £20,000 per year, because just talking to a lot of people, they don't even realize it exists.
Absolutely.
It's quite interesting, really.
And if you looked at it of your average, well, maybe it's not average, but your family of 4, husband, wife, 2 children, between the parents, that's £40,000 a year that could be put away. This is obviously post-tax.
Yeah.
And then with the children, I think the junior ISA, which can also be stocks and shares from when they're born, is about 9,000. So if you combined it, you've got a huge, well, it's not, maybe it's not huge for some, but it's not far off 60,000 a year for that, in inverted commas, average family. So it can build up to be, well, you come across it in the press, you read about ISA millionaires, and they can they could be taking a passive income from that eventually. And as it currently stands, tax-free.
I know, yeah. And you've kind of like hinted at one of the concerns is, as it currently stands, it's tax-free. I'm hoping things stay the same, particularly how I'm using it. But you never know whether the next government will see these tax-wrapped ISAs as a potential source of tax revenue in some capacity.
Interestingly, it was a Labour government. We don't bring politics into the podcast, but it was a Labour government, which some might not have expected, who brought it in the first place. And there was that general concern that people weren't saving or maybe investing enough for their retirement, and that was one of the reasons it came in the first place. However, some might say it's got too generous at the moment.
Yes, I mean, as I said, all you can do as a private is just keep track, make sure you're towing the line okay, and you're following the law. But they've not really.
Always.
Yeah, exactly. This the Investor Way is a very pro-law podcast, uncontroversially.
So we're coming towards the end, Gavin. What else should we talk about?
I do have 2 specific funds here. Now, we've kind of touched on a lot of this already, but basically I've just got just some things to consider with what index fund to pick and things like that, or how I went about it in any case. So one of the funds I like a lot is the Vanguard US Equity Index Fund, accumulation type. And it's basically it tracks the S&P total stock market. So that includes large cap, mid cap, and small cap American companies. It's got very low fees of 0.1%. And so basically it kind of like what we were talking about earlier with the value of the American stock market. It captures all that, but it also captures the small and medium-sized companies as well. And then so that forms part of my portfolio. At the moment it's doing okay-ish. I'm very happy with it. And it just kind of like exemplifies what's so good about passive investing, really. The standard question, because I know lots of people pick the S&P 500 for their American exposure, and I've just got kind of like a few reasons why I picked the US equity index fund over the S&P 500. So the S&P one on Vanguard is an ETF, which you currently cannot do an accumulation in, so you just get it back in dividends. It's not a massive difference, but to me that was quite important. It just automatically reinvested, and the fact that it's an ETF as well and not an index was also important to me. And then I just think the main thing, and this is just a general feeling rather than anything else, is that I like the fact that I've got exposure to the small and medium-sized companies as well. You could argue with the greatest potential of growth. Whether that's been the case the last 10 years or not, particularly with big tech stocks, I'm not sure. But I like the fact that I've got that exposure. It probably is slightly more risky, but I'm quite happy to bear the risk. It's also got a lot more companies within the portfolio as well, the US equity index fund.
Interesting. And I think there's something also to add is that in the UK, we do have the Vanguard platform that you're referring to, which is the sort of direct to consumer platform. That's relatively new, and we've only had it for a few years in the UK. Vanguard funds have been around for much, much longer, I think since the 1970s. The downside, ironically, of the direct-to-consumer Vanguard platform is that it doesn't actually have all of the Vanguard funds on it. It's got got a decent selection, but I suspect that one that you the American index that you referred to, they probably do an accumulating one, but ironically, it's just not on their platform. So some of the other platforms, whether it's Hargreaves Lansdown, etc., they probably do offer a wider range of the Vanguard product. I guess it's all about the fee structures for the platforms as well, not just the funds. The Vanguard, I did use the Vanguard one for a long time, and it is up there with the cheapest. I worked out for me, and because I had some individual stocks as well, that it was slightly cheaper holding holding the Vanguard funds on a different platform, which wasn't Vanguard. But anyway, that's another aside. And the nice thing about that Vanguard platform, apart from it having low fees in itself, if you're just buying the Vanguard products, it doesn't charge you a fee to buy them or to purchase them. There's not a trading fee, which is nice. No transaction, exactly. But anyway, we won't. There are other. Well, BlackRock is the other massive one. The Vanguard, and it's got that nice story with Jack Bogle behind it. If anyone is looking for a book on this sort of approach or index investing, Jack Bogle's Common Sense Investing is one of the first ones I would suggest. Other than that, I would say, if I were to pick two, Burton Malkiel's A Random Walk Down Wall Street was excellent. That was very influential. And also Andrew Craig's How to Own the World. They would be my three. They certainly influenced me a lot. And it was maybe about 5 years ago that I really was moving away from the individual stock picking. Because when I started, I'd read different books, but nobody had taught me about it. So it was all sort of, I suppose, discovering for myself. And I'd been more influenced by sort of the Ben Gray and Warren Buffett. Maybe it took a little bit of time to realize I wasn't either of those two. But I do greatly admire them. I think there's huge wisdom in the books. And then even on this side of the pond, Nick Train and Terry Smith, they're both in a similar vein. You probably wouldn't go far as to say value investing, but more quality investing.
I'd say so.
But I would say I'm with you for the large part, Gavin. I think and what, as Sam has pointed out to me, there is a pastime in stock picking too, and that can be, something that you enjoy.
Yeah.
It doesn't form going forward, and for a number of years now, it hasn't formed the majority of my portfolio, but I still do it. And there are a few companies we've come across on the Investor Way that I think, wow, I like that a lot. Rightmove, for example, being one of them. And I have bought those stocks and added it to the portfolio. But I would agree, Gavin, the core and being a busy person, it's difficult to see yourself beating the market and also having the time to even try to beat the market, and the weight to the argument that it's, no matter who you are, it's very, very difficult to do. So the chances of you being a busy person, allocating the time and being able to do it, it's, you're looking at something that's impossible, or it's
very, 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 very difficult kind of thing. And then it's one of those things that I could always turn to it if I wanted to. I could always do individual stock picking if I had the time and the means to do later on. But I think the most important thing, the famous phrase, time in the market beats timing the market. So the most important thing with all of this, in my view, is just making sure you've got an index fund, or you're doing dollar cost averaging into something. You're putting that, you're getting that portfolio building so that you can take advantage of compounding, and then you're getting more comfortable with the platform and the materials as well, so that you're well positioned in the future. That's really the main thing, because even with things like choosing between index funds, to be honest with you, the difference between S&P 500 and the US equity index is going to be very, very small. I don't have the figures in front of me, but you could say you're splitting hairs. It is personal preference, to be honest.
Yeah.
So it works perfectly for me, but the limit, you've kind of like skirted around it, but I suppose what people have an issue with this kind of investing is, A, it's not as exciting, and B, you're not going to get very rich in a relatively short period of time. Whether that's your goal or not, is another matter. But you're not going to get those huge returns, which you can theoretically get with individual stock picking. So you can beat the market much, much more with individual stock picking, and potentially have a much bigger portfolio for it. So the standard rate of return is, I think it's about 10% per year.
But if you did 10% a year, you'd have doubled your money in 7 years, and you'd be a very rich man, Gavin.
Oh yeah, no, God, yeah. I'm not looking for a strategy change. I'm just saying, all I'm doing is I'm trying to understand why people would pick other investing strategies like yourself, like Sam, over this one.
I think there was there is also a lot of cynicism from people who do, from other wealth managers, that they want you to be invested with them, they want your fees, and they will treat this with a lot of cynicism, skepticism, and you will be talked out of it. That is something else quite common, because while Vanguard and BlackRock do make a lot of money from the passive, but it's on the smallest margins, and it's done almost entirely by the volume that they have. So it's not, when you could be taking several percent as an active manager, that's much more attractive, and lots of people want to be in on that. So I'm with you, Gavin, and I think you've offered a lot of interesting insight, especially for someone who is again, young professional person, and I wouldn't say have a particular interest in dedicating your life to investing, and it's not your full-time job, and this does fit and lends itself well to that, and getting that equity growth in the long term.
No, and I'm really enjoying it. That's the other thing. And it's always fun to chat to yourself and Sam about such things as well. Sam has had many, many things to say over the years about lots of investing things.
I mean, even just following individual stocks like we do on the Investor Way and reporting with the updates, when I'm not invested in them, I form views on the show, and then you see how the company, it plays out over time. The fantasy portfolio, maybe it does allow for that in a sort of safer way. We're not putting our money on the line. But again, the fantasy portfolio, it is easy to allocate fantasy money to things. When it's your own money on the line, it changes it completely. That's something else, and everyone can. Yeah, go on, Gav. Sorry.
Yeah, well, no, it just sounds like I think we're wrapping up a bit, but I've just got a few final thoughts really. And this is just kind of just general musings on passive investing, and be keen to hear your thoughts. So one of the main things is 30 years ago, someone like me, the number of people like me was much, much lower. So it wasn't as well known that a very effective strategy was to just do monthly investments into a generic low-cost index fund. Those products often didn't exist, and if they did exist, no one knew how to access them. So you had a lot more individual stock purchasing. In fact, that was the standard. But now, what I'm saying, so nothing I'm saying is new, and it has almost become common knowledge, certainly if you've got a degree of interest in the subject. So what's happened is a lot of these big companies, they used to be maybe, I think, so the figure I've got here is 20 years ago, 3% of a stock in a major company in like the S&P 500 was through an index fund. That's now been consistently increasing over the last 20 years, and it now stands at around 20%. So in any given company, 20% of the stock is through an index fund, which that is unprecedented as far as I'm aware. So does that distort market conditions, and does that change what we think of index funds fundamentally? And ultimately what I'm leading to is there a bit of a bubble with index funds, because everyone, well, a lot of people kind of adopting a very similar approach that I am, in that just emotionless, robotic, automatic investing?
Yeah, I think that is a very interesting question, and it's something that I think about, and it is a concern there. It hasn't stopped me from following the approach, but it is a concern. And I think also I don't know how it's in the longer term it's going to impact on companies and almost that corporate governance, in the sense that you've got Vanguard and BlackRock with huge power, because they hold the votes that you would otherwise hold if you were an individual shareholder. And I appreciate those individual shareholders, even maybe historically a lot of it had been institutional, but don't have a vote. So you can't, if there are bad practices happening, it's really Vanguard and BlackRock who are deciding and some other big institutions, what's going on. And I think that is a little bit concerning.
No, it's something I think I'm going to read more on the topic. If any listeners have got any recommended reading, I'd be keen to hear, particularly on that kind of going forward. Is that a concern? Why is it a concern? What could happen, basically? No, I'd be keen to read more.
Yeah. Okay. Well, some interesting thoughts to end on there. But if you would like to join the Investor Way and come on for an interview, please do engage with us on Twitter. Otherwise, we'll see you again next time for the Fantasy Portfolio Review.
Thank you very much for having me.
You're welcome, Gavin. See you again next time.
Thank you for listening to the Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.